Ladies and gentlemen of the crypto space, we're live on a Monday, October 16th at 11:31 a.m. And I am Noah Blitzer. I gotta love that mid-journey stuff. I like to have fun with it. All right, all right. Fess up. Let everyone know who bought the news. You don't buy news, and I would like to express so vigorously I don't like the notion of buying the news, or selling the news, or either or. And typically it's buy the news, sell the event, or some stuff like that. I don't even care for the inverse. I want to reprogram everything, and that means overcoming our greed, our fear, and we cannot invalidate emotions. But isn't that like a great goal to try and take them out of the equation? And that means at least you need a way to do it, a methodology to do it, even though you're not necessarily going to be able to do it. Because clearly, when you see number go up, you're like, oh, that's cool. But isn't that like, that's my goal? My goal, and I said this in like 2022, when the number starts to go up and liquidity returns to markets and cyclicality does what it does, I want to be like, all right, that's cool. That is my goal. It's not to be excited. It's not to be exuberant. It's not to be, you know, confirmed or vindicated. It's, my base case is I expect things to be cyclical. And that's the way the world operates. That's the way nature operates. So the cyclicality will occur. The number will go up at some point. And I'll be sitting here saying, oh, that's cool. Fake news, that's right. You said that early. Haha, thumbnail's incredible. 3 likes pre-stream. We can do better. 7 likes. How about that? I appreciate all of you jumping on the stream early. Igor's in the house from Finland. Beautiful country. Complicated continent. Oy, oy, oy. Good stuff. Good stuff. My bad. Sorry, guys. Yo, yo, yo. Tapsy's in the house. All right. Where are we with everything? Obviously, the war has got everyone on edge, but are we ever not at war? Did we not see some pretty disappointing things in Africa over the last 1, 2 years? Horrible, horrible stuff. Absolutely horrible. Um, but this is not the war channel. This is the financial channel. So that type of violence at a global level, especially when it hits mainstream media, gets everyone on edge, gets everyone's emotions brewing. But the base case for my behavior remains completely unchanged. There's nothing to do. Please configure backup stream the comparison. Oh no, the stream looks good. I saw a warning message on my screen. Um, so liquidity is just horizontal, and that's why the markets are doing what they're doing. And some would argue that a credit event, um, but from a domestic liquidity perspective, it's not going to be a typical credit event. Maybe the credit event is with regard to sovereign bonds and the way they're used as collateral. It's not like uh, we haven't seen mass swaths of bankruptcy. It's just been monumental. You pull up Fred, good old Fed economic data, and see the amount of bankruptcies we had. But obviously, if you're comparing to '08, and the number of bankruptcies is about the same as '08, but the system is that much bigger compared to '08. So what does that mean? From a proportional perspective, the percentage of bankruptcies is significantly lower than '08, even though the number is about the same. We've seen you can't really compare to history apples to apples in that regard. It's a different system. So you really have to have the perspective of how the financial system is different. And this is probably the biggest perspective to have on how the financial system is different. This is why markets are basically horizontal. This is relatively horizontal, and the dollar is treading water, unfortunately above the 100 region. We haven't seen a significant move down, so it's basically uncertainty. You see a big move up here, and you see any move here with great deal of breadth. big move, 1, 2, 3 points, and you'll have the markets react. You see confluence from between oil and the dollar, and you'll certainly see markets react. VIX popped to 19 and change on Friday. It's back down to 17. The vol suppression team is in full effect. Where are we on reverse repo? See, it's about horizontal, about 5 trill. Significant drainage, just the long chart's pretty much irrelevant there. This obviously went into the short end, and this is compensating for Treasury issuance, which has been obliterating the long end. Big moves, 2%, 2% and change on the 30-year. Not much to take away. I mean, it's not like the directionality has significantly increased its rate of change. The directionality is persistent. Let's go over to the candles, and we could zoom in a little bit. So I wanted to see this type of trend. So obviously it's a bit of a triangle of compression, and we're only on 2 weeks off the highs and rates, that is, and it's mostly a bearish engulfing, but it's not quite an entire bearish engulfing, so we do have some upward pressure. So this is consistent with a triangle compression. You can see that if you come in on the 4-hour, higher lows and lower highs. So when this type of trending occurs, decisions are being made. Longs versus shorts, either spot or leverage or whatever, what have you. That decision is being made with regard to market actors on directionality. It'll be interesting where we see correlation land, especially in 2024. It would be quite meaningful to see a continuation of not inverse correlation, because traditionally equities markets crash, and all that liquidation heads into the bond market, the sovereign bond market. But we've seen correlation where they've depreciated in the same direction. So imagine seeing like yields collapse, bonds rally, and equity markets rally. And that is not invalidated in any regard from occurring. In fact, I think based on the last couple of years, why would that be completely unexpected to occur? Kind of makes sense that that would occur based on the last couple of years, because risk off did not occur in 2020 and 2021 in the same way that it historically did. So do we see equity markets, demonetize into the bond market? I don't know. That'll be an interesting one for next year. Now does the reverse repo continue to drain into the short end? Sure. That's clearly the case. How many folks have said over the last year they have $1.152 trillion left, and then where are they going to get their capital from in the short end of the curve? And that's when you start to see divergence between, less than 10-year bonds, less than 10-year treasuries, and the Fed funds rate, and that's when the Fed is losing control, and that's when everyone starts to freak out, because the whole point of what they do with the reverse repo, is they're trying to set the rate, the market rate of yield on that section of the yield curve, and they've done that quite well. What they haven't done is attained any control whatsoever over the long end. And that's why we see this, that's why it's generally accepted that the long end is the market pricing of risk, and the short end is just basically an expression of what the Fed wants to see from, a cost of capital perspective. Let's go back here. Let's go over to the monthly, and you can see that if this is the expression that everyone's been looking at, the Fed's balance sheet minus the reverse repo minus the TGA, it's remained relatively up. I mean, clearly it's up since 2020, and it's up since the dip in July, summer 2020, and it's been basically horizontal for how many months at this point? Well over a year and a half. This expression has been basically horizontal. Oil, look at that triangular compression that I drew on the log chart, obviously. See you in 20 years when this triangular compression is complete. Um, a lot of fear being spread by the war that oil breaks out to the upside with strength. Not impossible. But to the downside is probably the only way the downside is possible is with that much of demand destruction. And is that not the case with regard to credit? I mean, I guess, you can't really say that folks are not using credit, even though it's like 20+% on a credit card, with the amount of credit that's been taken out over, second half 2022 and 2023. When it broke the $1 trillion threshold, it's quite remarkable to see. Um, but at some point, that's got to dry up. And as I retweeted Jeff Snyder the other day, gasoline demand has been down significantly. So there's been a divergence between gasoline demand and oil prices. And that'll eventually drag down oil prices if that trend is to continue. Let's look at the Bitcoin candle for today. So look, this is why the news is irrelevant with regard to anything that occurs uh, from a technical perspective. Look at this. There's nothing here. There's nothing. It was a big candle. It was a 10% move, but that means nothing relative to the grand scheme of things. And it'll drive you nuts looking at the news. The news will always lead you in the wrong direction. And also the general methodology of falling for hype and excitement and adrenaline will also lead you in the wrong direction. Let's zoom in. So on the monthly, you know, we've seen some nice support finally on the 50 SMA, and a 10 SMA, 50 SMA bullish cross is also a bit comforting because we dipped below the monthly 50 with quite some strength, and we totally got rejected by it in January in 23. But generally speaking, this is a breakout and a retest, and it's not even a retest of the monthly TWAP. Look at that. You didn't even retest the TWAP. So you broke through the TWAP, and it was literally just obviously a breakthrough of the 50 SMA also. But it held support nicely on the 10 SMA, and thus far it looks to be holding support on, the 10 SMA probably because it pushed through the 50 SMA. We haven't seen a clear expression of support on the 50 SMA, but we have seen expression of support at or really damn near the 10 SMA. So we still have that expression going on as the 10 SMA pushes past the 50 SMA to the upside. So we've got 15 days left in the month. It would be very interesting to see it close above the 50 and the 10 SMA. Let's go into the weekly. Everyone loves to look at the 200 on the weekly. And what I am more interested in is maybe the 100, because we haven't seen even a touch of the 100 since the bearish cross in May of 2022. So we pushed through the 200, but the 100, a shorter term moving average, this is the first time we've interacted with it. And bear in mind, look at the directionality. It's clearly a bearish cross of the 100 SMA versus the 200 SMA on the weekly chart. But look at the 50. So, depending on how the market heads, it would be nice to see a 50 SMA cross of the 200 SMA, which would be a golden cross, short-term price action, passing long-term price action, and the 100 SMA will dip below. It'll take some time to catch up. 50 SMA responds much quicker than the 100 SMA, obviously. Let's take a look at this one. This was an interesting one this morning. Look at that very clean interaction with the 200 on the weekly, Ethereum denominated in Bitcoin. That was nice to see. Clear expression of support there. We're on the logarithmic chart. Let's zoom out to the monthly. So if you go to the 3-month, you'll see the time-weighted average price, and we've been breaking to the downside. So there's not much support there from a long-term moving average. But what have I talked about with regard to the 3-month? Basically, in general, 3-month, 6-month chart is good to see from an average price perspective. If you're below the time-weighted average price, it's generally an opportunistic time to acquire additional units. And the question becomes, how far do you get below? Maybe get another 10%, 15%. But I don't expect Ethereum to deviate significantly below the price of Bitcoin heading into the future. I think this will be cyclical, as all things are. So you see the push below the 50 SMA, the time-weighted average price, and this is the 10 SMA up here. But how far it goes, that's the interesting question. If you go to the 6-month chart, you do see a time-weighted average price, and lo and behold, you have basically a solid support on that value. Clear bounce off of it and a push back to the upside. Not much data to go on with a relatively new asset being Ethereum versus Bitcoin with a longer history, but that's pretty clear to see. Anyone can see that, an expression of support on the 6-month time weighted average price. Difficult time frame to get your head around. Each candle is 6 months. Let's go over to Ethereum. So generally speaking, Ethereum has depreciated relative to Bitcoin, Bitcoin denominated, but the charts, the trends are very much in line. Bitcoin has a little bit more strength on the monthly, expressing support on the 50 SMA down here. And then if we go over to Bitcoin, you can see you're well above the time-weighted average price. So you're expressing support in the 50 SMA just like Ethereum, but on Ethereum, the time-weighted average price is actually higher. So you've pushed below it, and there's basically a giant air gap below it. But then again, doesn't everyone argue that Bitcoin supports everything? Everything tracks relative to Bitcoin. So as long as Bitcoin is in a position of relative strength, these moving averages and the time-weighted average price should express similarly. ES, S&P 500. I don't know. I mean, clearly everyone's is thinking that this tracks with systemic liquidity, just like what we're talking about with regard to crypto. Meat space. Who's investing in this? And I understand who's investing in it. It's the flows, it's the 401ks, and it's just so disenchanting to even consider an investment. But I guess this is where everyone goes. This is where the normies go. This is where the retirement population goes. This is their place of investment. It's surely not where I look, and it's likely not where everyone else looks. Let's hit some comments. Renab, hey Cap, good morning. I found out your stream recently and have been learning a lot, trying to develop an evaluation framework and realizing it takes a lot of time to understand any one protocol. That is quite reasonable. Think from a perspective of monetary policy, and clearly you could talk in terms of very standard stuff, inflation, deflation, disinflation. But what's even more meaningful is comparing it to the traditional financial system, meat space. And in that regard, what you have in crypto markets is basically the same protocol over and over and over again, which is a credit system. Maybe a money market fund, maybe a general broad credit system, or maybe even a liability printing system, which is basically what global dollars are. Bank liabilities, or even eurodollars, where you have like a non-redeemable stablecoin, which is literally a eurodollar. There is no euro, there's no dollars in the eurodollar system. It's all built on owing dollars, and you can print a dollar liability using collateral, and you're not looking to redeem it, but it's because you could pay with a bank deposit, ACH, or whatever settlement, so is it SEPA, or whatever bank currency transfer regime is in your part of the world. You could pay with a bank deposit. You have a credit card in any country around the world, you could pay that credit card with a bank deposit. So you're not paying with dollars, you're paying with that bank's dollar liability system, which is the eurodollar system. So that's really the systems that have been created in the crypto markets. It's just the scale and scope is far above anything that has been created by a sovereign country. It's kind of a system like you can think of the cloud. It's a system above and overarching all nations, and that's why it's so fascinating, because it is an expression of what has been created in meat space, except there's a lot of characteristics that are iterative. It's obviously a long journey to really assess what the hell has been created, but suffice it to say, if I say to you, there's probably about 1, 2, 3 dozen protocols that have any true meaning, that have a true staying power and longevity and characteristics, attributes of survivability, should help you limit the amount of protocols you're looking at. You could have a credit protocol. It can be new. It doesn't mean shit. It's been done 10 times over. We just had such an incredible onslaught of protocols in 2020 and 2021 and 2022 was obviously just a bear market, that there's few coming online right now that are going to be anything innovative. I mean, the only thing that's probably going to be incredibly innovative is like Tapioca, and they've been taking their time, and that's really good to see. Quite comforting, the amount of auditing and due diligence they put in. Ever since my Sir Joe's in the house, ever since my relatively poor average entry of 5.5 on CVX, I'm hesitant to enter my desired Ethereum position. I know you see it as cash, no real question, just expressing sentiment I have. Now, bear in mind, I define it as cash because I will spend it if I need to. You kind of want your cash to appreciate. And now, the complexity with Ethereum and Bitcoin, defining it as cash, it's volatile cash. So your base case is that it's going to depreciate. You always have it at your base case that it's going to depreciate, because then if it appreciates, you're like, oh shit, it went up. That means you're always winning. If you're always expecting the price to go down and it doesn't go down, you're beating your expectation. So it's so much psychology to be able to manage these assets as part of a sustainable portfolio, a portfolio that survives, that's able to traverse all of this cyclicality without driving you absolutely insane. Now, maybe your Ethereum position is too large that you want your desired Ethereum position. It's just, for instance, my cash position, Ethereum, Bitcoin, and USDC, for what it's worth, is probably about 40, 40, 20, maybe even 45, 45, 10, 10% being USDC. And that's where I'm at. And weekly cash flow right about now is going to USDC. For a while, weekly cash flow was going to Ethereum. And probably a couple of weeks ago, I converted a fair amount of the USDC into a bit of Bitcoin. So now I have a healthy cash position that's for about, let's say, 45, 45, 10 Ethereum, Bitcoin, USDC. Now, clearly, if some crazy shit goes on in the bond market and S&P 500 takes a 20% shit, maybe I'll adjust. Even on the downside, there'll be dollar-denominated losses. I don't mind. What matters is I have the quantity of cash that I need for next year. Now, obviously, this is all dependent on how much is a lot and how much you need. And this is an interesting part of capital management. A lot of people think of looking at their portfolio and they want to see the number, a specific number, or a number go up. But nowadays, I primarily think in terms of expenses. I primarily think in terms of how much capital I need at a certain time period. Like I'm looking for a certain amount of capital next year. Let's say June, July of next year. I have a certain amount of income from work. I have a certain amount of income from assets. I have a certain amount of assets and cash on hand. And what can I do? How can I play with those numbers to ensure that I have a certain amount of capital in June, July of next year? So I have to take into account risk. So if risk increases in the market, I probably want to adjust my cash position to be a little bit less Bitcoin, a little bit less Ethereum, and more USDC to take a little bit of that risk off the table so that I have a certain amount of cash next year, considering how much cash comes in from work, how much cash comes in from assets. And it's like just to be sure. So I'm always going to want to have exposure to Bitcoin and Ethereum as part of the cash position because you could always sell it to pay for things. But if the volatility is too much, excessively downside, you take a little bit of risk off. How much further can it go down? I mean, look at, move is quite interesting. This thing, how could it stay elevated? At some point, my base case is the demonetization of equities and bonds just rip to the upside, vol gets completely crushed. I just see so much more potential for higher lows. I guess that's the best expression. So higher lows relative to like 17,000. So let's say you get a flash crash like 2020. Like 2020, it was higher lows. 3,800 and the low was 3,100. So you'd literally need that kind of like systemic capital destruction event to see a higher low than 15. So let's say it's 1920. I just don't see that type of event, but like that's the whole point of risk management. That's like worst case. Worst case, you probably see a higher low because at 19 grand, there's enough capital in the system for that to be taken as a favorable price point to acquire assets. That's a massive reduction in the price, 28,000 to 19,000. So I'm probably around like 24, above 20. I'm like, all right, that's probably where it can be, and I'm not going to sell between there and then. That's not something I want to do with the portfolio. I don't want to decrease what I have, potential exposure to upside, because if we see that kind of move to the downside, I expect accumulation to be some sort of short term, maybe a month or two. See a big wick to the downside, and a month or two later it goes back up, and that's what's expressed on the monthly TWAP. Expressed on the monthly TWAP is on average, you see any price below the TWAP, it will be higher in 3 months' time. So you don't buy above the TWAP, you buy below the TWAP. So let's see where we are in the monthly TWAP. We're below the TWAP. So on average, in 3 months from now, look, you fell below 1, you fell below 2, you fell below 3. On average, you were higher 3 months later for Bitcoin. You fell below, found support on the monthly TWAP back in April, and then May you fell below, October you fell below, November you stayed below the monthly TWAP, and December you ripped back above the TWAP. It would take a lot for this time weighted average price to start moving down. I think it'll take a structural change in the narrative, like something is invalidating, and it really brings into question the entire directionality of the system. But heading into like December, January, February, I expect that we'll either be interacting with the TWAP, maybe above the TWAP a little bit, expressing support, TWAP as support. But generally, look at the trend. Anything below the 3 month time weighted average price, 3 months later, you are above the TWAP. So this type of chart gives me comfort that even if you have a depreciation over a month or two, in a month or two, it's going to be back up. Anyway, hope that helps. King Mappo, I've heard you refer to a liquidity event in 2024. Is that referring to bonds maturing with lower rates and have to be reissued at higher rates? All right. Not necessarily. It's kind of like we already have the liquidity event, and that's basically the HTM portfolios with the banks and collateral just depreciating to point where you have liquidation cascades. The thing about banks is they have this concept of an HTM portfolio where they are able to report the face value of their collateral and not the depreciated value. They're not marking it to market, and that's kind of the game that the banking system plays, the U.S. banking system especially. Now, if they have to mark to market and have to, write off these losses, that would be pretty much devastating to their balance sheet, and they'd be reporting significant losses in the composition of their portfolio. I don't know how that works, and we'll see. We'll see, especially heading into January, February, March of next year. Um, can some sort of mass liquidation event occur? Sure. Collateral depreciated, which causes the global Ave health factor to fall below 1, and there goes your forced selling. So, can we have forced selling? Of course. That's exactly what occurred in March of on the 3-month chart. If you go to the monthly chart, you see it in March of 2020. That's what this forced selling was. And then everyone that was forced to sell because their collateral was compromised, it was bought. Within 1 month, everyone that was forced to sell from 6,000 down to 3,800, all their assets were bought at a discount. So that's something similar that I would expect. I mean, look at coming off the lows. Here's your lows and your appreciation. It was relatively horizontal between June of 2019 and let's say September of 2020. It was relatively horizontal price action. And that's something that we see pretty much here as well. March of 23 up obviously until October of 23. It's relatively horizontal. So another couple of months and cycles will cycle. That's generally where my mindset is at. Brian, good morning. Austin, hey Noah, what was your thought process behind taking a convex position over, say, Y curve? Basically Frax. Frax. My opinion is lots of potential. I have a high opinion of what they do, their cadence, their release schedule, and that's where their cash goes. That's where their vote rentals go. So that's the cash that I want. So it's not just like a percent return I'm necessarily interested in. I also want to know where the capital is coming from, where the income potential is coming from. So obviously being a base layer maximalist, I know where my income is coming from with regard to VECRV vote rentals, but that's not primarily where Frax throws the vast majority of their capital. Why? Because of their CVX control, how much they control. So that was my reason for doing that. I wanted that cash flow. Hope that helps. Austin, you mentioned you took a position in the previous stream, essentially why convex when it seems limited. I want to see if I'm missing something. Well, that what I just said with regard to convex, that's my rationale. My expectation is that RWAs and just the concept of liquid and fungible and portable money market deposits, it's a big deal. I think that has the potential to significantly expand the global currency system, and that's literally what creates all of this financial activity, especially since 2008. We've seen much more financial expansion as compared to actual growth from a GDP perspective, and that's concerning from a longevity perspective, but that's what's been occurring. So my base case is we see significant financial system expansion in the next couple of years, 1, 2, 3 years. And that would also mean more collateral in the system and more printing of liabilities. Eurodollar market gonna get lit. So there's a huge amount of collateral that needs to be refinanced next year. Mike Howell says 11 trill. I probably would say about 11.5 to $13 trillion, depending on deficit spending, will come fresh off the Treasury printer. And that'll be fresh on the run treasuries, as they're called. And those on the run treasuries, it's not the short end. This is the long end. And in the long end, as long as if there's a negative real yield, they're going to be used to print liabilities to engage in financial activity to put them to work. And I don't think they're going to be able to sustain a positive real yield on U.S. Treasuries for very long. History shows they can't. And Luke Groman talks about it very well, where it needs to be really negative real yield for quite some time. And they should have let inflation run hot, but that's another story. But I don't think they could sustain the positive real yield without significantly repressing, growth. And growth is just, It's not sustainable, and it's because of demographics, and it's barely the debt, the expansion of the currency units in circulation that has been juicing like GDP nominally. Has there really been any growth since 71? Some argue not really. Nice point about my desired Ethereum position maybe being too large. I'll put it into brain marinade. Well said. Position size and actually taking a position is the hardest thing we do. The last thing you want to do, the last thing anyone wants to do, is be indecisive. Take a position, sell it. When? All that shit used to drive me nuts, which is why I think the locked position is the biggest invention I've ever seen in financial markets. An actual locked position. Buying bonds is not a locked position. You could sell the bond. But when you buy certain crypto positions, it's not a position, it's a purchase. You can't even sell it. That's crazy. You can actually do that with Bitcoin. Bitcoin has locking in the on-chain transactions, but that's not really done. I don't really understand why that's not really talked about or done more. I just think that that's a big thing. Austin Frax was what I was missing. Thanks. Yes, indeed. Hope it makes sense. That part of the income, interesting thought. Yeah. Obviously my expectation is when liquidity returns and a positive sum environment returns to the crypto markets, I generally expect significant new protocol creation, like the Cambrian explosion. Liabilities return to the global financial system, huge amounts of capital inflow into this emerging market, huge amount of investment, and just protocol. And we've seen it be the case that for a protocol to be successful, they need to finance liquidity. And then obviously for a protocol to be successful, they need to finance it sustainably, optimally from cash flow. So, but where are they going to go to finance liquidity? Where do you go? And that's basically Balancer Federation, that's basically Curve Federation, and a couple of others. So I think next cycle is going to be interesting. We'll see how these federations evolve. Maybe you can go it alone, like a Velodrome where they're going it completely alone and there's no real accumulators, the same way we have just protocol after protocol accumulating Curve, or even like a Prisma accumulating convex. And Aladdin does that nicely as well. So even you have accumulators of the derivatives, which is one heck of a federation if you're thinking even in terms of the way nation states operate. So that's quite interesting. Tapsy, speaking of Frax, interesting for international users to get access to U.S. Treasuries. Now that is not just Frax. Literally, MakerDAO offers zero access to U.S. persons. There's been a big increase in not just VPN blocking, but also like onion router blocking. Frankly, I don't know how the hell they're detecting, especially onion routing, but they're basically cutting off U.S. persons. It's just pure international. So that's interesting. Clearly, GenPop outside of the U.S. being directly exposed to these types of instruments is not something historically they've had access to. So you make a good point. So I have a high opinion of what Frax is doing, and I think it will be of big interest. And I think it has the capacity to create endogenous liquidity. So obviously you have capital inflow, a positive sum environment, but you could also have capital expansion, liability printing using the collateral that exists in the system. And when a favorable environment returns, that's exactly what we saw with Abracadabra. That's what we saw. That's what MakerDAO does, obviously. Frax has a bit of a different story, but obviously CRV USD is on the table this time around. These are all liability printing regimes and non-banks. So you put it into meat space terms. That's what the non-bank system does. That's what the eurodollar system does. They take collateral and they print dollar liabilities. And that's what these systems are. Hope that helps. We're going to wrap it up in a couple of minutes. I don't think there's anything else too interesting to look at. Everything's basically horizontal today. Even Bitcoin with its 10% candle. Look at this tiny little candle. Everyone was so excited this morning, and all they were excited about was this tiny little useless candle. So zoom out and don't drive yourself nuts, and don't be degenerate, and let time do the work, and think about composition. Be more excited about the composition of the portfolio, because think of it as a craft, like an art. This is why the size of this position is this relative to this, and once you find that kind of comfort, the time will do the rest of the work. That's a big realization. 22 people made it to the end of the stream. 14 likes. Hit that thumbs up button. I appreciate all of you. Tell everyone to subscribe. In the description is the link to the most rational community in the entire crypto space. I appreciate everyone in there. Have yourself a good one. I will see you later this week.